Right, so having dealt with the summary of the principles of IFRS 16 in the previous video, in case you missed that, I'm going to be linking it in the description box, so you can check the description box and look at the summary of IFRS 16, as well as the two-part series that I did on IFRS 16. All these will be in the description box, so you can check the description box for all of these in relation to that. But here, we want to look at a question in relation to how we can use the principles that I discussed in the part 1 of this two-part series as well, in order to solve a question in relation to that. So let's look at a question. I'm going to put the question on your screen as well. I'm going to be reading it out as well in relation to that. KK Limited enters into a 20-year lease of one floor of a building with an option to extend for a further 5 years. Lease payments are $80,000 per year during the initial term and $100,000 per year during the optional period, all payable at the end of each year. To obtain the lease, the lessee incurred, that is KK Limited incurred, initial direct cost of $25,000. At the commencement date, KK Limited concluded that it is not reasonably certain to exercise the option to extend the lease. The interest rate implicit on the lease or in the lease is 6%. So let me take it again. KK Limited enters into a 20-year lease of one floor of a building with an option to extend for a further 5 years. Lease payments are $80,000 per year during the initial term and $100,000 per year during the optional period. So let's break that down. So the company KK Limited is entering into a lease. Let's see if I can divide my board. I think I have a full board on the screen. Yep. So if I divide my board, KK Limited, in that case, so you realize that the lease term is 20 years, but they have a further 5 years to go, but the current lease term is 20 years. And we are told that the interest rate implicit in the lease is 6%. And we are told that the annual installment payment on the normal 20 years period is how much? $80,000. And that is per year. But most importantly, it is payable at the end of the year. Now, why did I emphasize on that? Because if we don't know when the lease is payable, then we will struggle with our subsequent measurement of the minimum of the lease liability. Are you getting the idea? So it means that, if you remember what we did in the first video, it means that we use the second approach where we bring the balance year, balance brought forward, interest, payments, and then we get the balance carried forward in relation to that. So we are told that the company is not certain that it will do any extension. So since it will not do the extension, we remain in relation to that. But we are also told that the company, to obtain the lease, incurred an initial direct cost of $25,000. Now, if you remember what I said about the initial direct cost, I told you that we always add it to the right of use of the asset. However, where the lessee is reimbursing us, then we subtract the amount that the lessee is reimbursing us from that in relation to that. So you got to be careful about the treatment in relation to that. Right, so these are the information we have from the question, and let's get going in relation to that. So what do we do first? Always, we need to find out the present value of the minimum lease payment. So $80,000 for 20 years, we discount it at an annuity of 6%, right? And that is going to be giving us somewhere around $917,600. $917,600. So let's take it one after the other. Now, this $970,600 is the minimum lease payment, and this is the double entry. We debit the right of use of assets and we'll credit what? The lease liability in relation to that. So that is the lease payment in that case. Then we come to the initial cost. Now there is an initial cost of $25,000. Remember I told you that when it comes to the initial cost, what do? We add it to the right of use of assets. So on the initial recognition, we will say that we debit the right of use with $917,600 and credit the lease liability with same $917,600. Make sense? And that is with the minimum lease payments. Then we come to the initial cost. The treatment of the initial cost is that we're going to be debiting the right of use with a $25,000, and certainly we credit our cash or bank with $25,000. Make sense? Good. So what does that mean then? It means that the initial cost of the right of use will be equal to the $917,600 plus the $25,000, and that should give us $942,600. $942,600. So that is the treatment for the initial cost of our right of use of assets. Now in the exam, we'll not do ROU. Make sure you write it in full, okay? I'm just being lazy here. Now, that is the initial recognition. So we go to subsequent measurement. On subsequent measurements, remember what I told you? We're going to be depreciating the asset using what? The lease term. And that is 20 years. Now here, we are not giving the economic useful life of the asset, hence we can't do any comparison. The only thing we have is the lease term, 20 years. And so we're going to be depreciating the right of use of assets over the lease term of 20 years in relation to that. So let's look at how we do that. So on subsequent measurement, what do we say? We bring the depreciation, the annual depreciation, and that is $942,600 divided by 20 years. And that, when we punch that out, will be $47,130. $47,130. So this will go to our income statement. We'll do the income statement extract in a moment. So that is the right of use. Is depreciated. So now the carrying value of the right of use of the asset will be the $942,600, right? Minus the depreciation of $47,130, and that should give us a carrying amount or a carrying value of $895,470. $895,470. $895,470. So that is the subsequent measurement for the right of use. Then let's go to the lease liability. Remember what I told you, when it comes to the lease liability, we carry it at the amortized cost. And most important thing is that in this question, the payment is made at the end of the year. I believe that was what was stated in the question. Yes, payments are made at the end of the year, all payable at the end of each year. So we will use this pro forma. We'll bring here, bring the balance brought forward, the interest rate implicit in the lease. We'll bring our installment payments, and then certainly we'll get the balance carried forward. Let's slash our dollar signs up. And the interest rate implicit in the lease is what? 6%. Now remember, before we go there, remember what I told you. I told you that when payment is made at the end of the year, what do? We split it into two, okay? We do for 2 periods because the carrying value or the carry forward value must always be split into the current component and then the non-current component. So let's go. So our lease liability is 917,600. So we take 6% of that, and that should give us 55,056. Then our annual payments that we are making is $80,000. So we do the arithmetic to get a carry forward value, and that is 892,656. 892,656. Now, we could have ended there, but that 892,656 is the total lease liability, is the total lease obligation at the end of the year 1. Remember, the interest, 55,056, will go to the income statement as a finance cost, and the depreciation of 47,130 will also go to the income statement as part of the expenses. However, we must separate that 892,656 into the current component and then the non-current component. So how do we do the treatment? Now, because payment is made at the end of the year, we will do for 2 schedules. Assuming payment was made only at the beginning of the year, then the workings would have been different, then the closing balance would have been also different in relation to that. So we do for the second period, we bring this guy up, 892,656, then we get 6% of that. So 6% of that is 53,559. We still less our annual payment, that never changed, 80,000, and that gives us 86,000 or 866,215. So what did I tell you about this? I told you that the second schedule becomes what? The non-current liability, and then the difference between the first and the second becomes what? The current liability. So if we do the arithmetic, the difference between that, it's going to give us an amount of 53,559. So let's see the arithmetic. 892,656 minus 866,215. Oh, sorry, that is 26,441. 26,441. Okay. 26,441 in relation to that. All right. 26,441. So that is how we deal with the treatment. So now let's extract the financial statement in relation to that. You good? So when we are extracting the financial statement, we first have the income statement extract. For the year ended year 1, in the books of what? KK Limited. So in the income statement, what are we bringing? Remember what I told you, 2 things all the time. The annual depreciation and then what? The interest expenses. So our depreciation will come. And that is 55 and 56. Then we bring our finance cost. No. I've exchanged it. Finance cost is rather 55 and 56. So our depreciation is 47,130. So this is what comes in the income statement. Then we go to the statement of financial position. In the statement of financial position, under non-current liability, we're going to have this. So let me clean this place up so I can have my figure there. So the statement of financial position. So statement of financial position, let's bring up cash columns as well. And then non-current liabilities. So under non-current liabilities, we're going to be bringing the right of use. And that's from our workings to, if we want to, and that is 895 470. Then we go to liabilities straight up because this is an extract. And under liabilities, what do we bring? Non-current liabilities. And the non-current liability we bring so the lease obligation, that should be workings, probably 3, will be a basic non-current, right? So 866-215. Then under the current, okay, maybe I could just take it to the last column. Okay, I just want to add the 2 up. Then we come to current liabilities. And again, we'll have another lease obligation. And that's going to be 6,441. So realize that when we add the 2 up, it gives us the 892,656. Now, this is an extract, so don't expect it to balance in relation to that. It's not supposed to balance, okay? It's just an extract, so we don't expect it to balance in relation to that. So this is also another question that you have to understand when it comes to the treatment of IFRS 16 leases. So if you have any questions, put them in the comment box, put them in the chat box. I'm going to be answering all of them for you in relation to that, and I'll see you in another video. Remember to subscribe to the channel to become a VIP member. That way you'll be the first person to be notified when I release great videos like this and any other strategic videos to assist you to be able to prepare well for your examination. And remember also to share the channel with your friends, your colleagues and loved ones, because my objective as always is to provide you with as much content as possible so you can prepare well for your examination, but most importantly, pass the exams at the end of the day. I don't want you to go through the pain, the stress, but I want to be there for you, hold your hands, assist you in order for you to go through this journey and enjoy the journey as you go through it in relation to that. Thank you, and I'll see you again in another video.